welcome back to Choice Trade's video education series. Today we're going to talk about stop orders, or just plain stops as they are sometimes called. Stops are a type of order. Stops are used alongside the most basic order types, market orders and limit orders. But unlike market and limit orders, which become live tradable orders immediately, a stop order does not begin as a live order. The stop order is effectively held back until it is stopped out. Once your order is stopped out, which occurs when at least one market trade is made at your stop price, it will become a live order, either a market order or a limit order, depending on which type of stop you use. Stop orders can be a powerful tool in any trader's toolbox. Let's find out why, but first, let's review the basic order types. Most traders use market orders at one time or another. When you make a trade as a market order, you do not specify a price, only that you want to buy or sell a security at that moment. In this case, the word market implies you are willing to make a trade at the prevailing market price in order to complete the trade as soon as possible. You are willing to buy at the ask price or sell at the bid price. By contrast, when you place a limit order, you specify a price condition that must be met before you want your trade to be executed. If your limit price is not met, your order will not be executed. A stop adds another step to placing an order. Not only do you have to consider the price at which you are willing to make the trade, but you also have to consider the point at which you are prepared to have your order go into the market. Instead of sending your order to the market immediately, a stop price holds the order in suspense. It is held in suspense until the security you want to trade reaches a certain price point. Once the stop price is met, the order goes in as a live order. Stop orders are essentially contingent orders. They are not fully executed until the stop price is satisfied. This is called stopping out. When the order stops out, the underlying order goes into the market as a live order. For OTC and NASDAQ stocks, that stop price must equal the bid price for sells and the ask price for buys for the underlying order to stop out and become a live order. There are a number of reasons someone would want to use a stop order, including setting an exit point for a position already held, or setting an entry point for a position desired. There are, in fact, three categories of stop orders: regular stops, stop limits, and trailing stops. In the next couple of minutes, we will show you the differences between each one of these stop order types. The first stop order type is the plain stop order. This order triggers a market order when it is stopped out. Remember, with a market order, you do not specify a price. Instead, you are prepared to buy on the current ask price or sell on the current bid price. The second stop order type is a stop limit order. Like the stop limit order holds back the submission of your order until it is stopped out. In this case, once the stop price is reached, a limit order is presented to the market. Think about the pieces you need to make this type of order. You need share quantity, stop price, and limit price. The last stop order type is the trailing stop. A trailing stop is an order that is withheld from the market like the stop and the stop limit. When a trailing stop is stopped out, it is presented to the market as a market order. But here is the key. The trailing stop does not have a fixed stop price, but instead has a fixed distance from a price, the highest trading price for the underlying stock, established over the period of time that the trailing stop is working. Think about that. With every minute of time that goes by, there is a possibility that the high price of the underlying stock may change. Let's look at the dynamics of a trailing stop over time so we are clear about how this works. Say we own a stock ABC and we enter a trailing stop order as a sell order. For the sake of this example, we will assume that we want a trailing stop difference of $3 off the stock's high price. In other words, we are saying our market order to sell ABC will become live once the price falls $3 from ABC's high price during the time the trailing stop is working. Remember, this difference is calculated off the high price of the stock while your trailing stop is working. Watch what happens to the trigger point as we fast forward through time. We place the trailing stop when ABC is trading at 31, with our trailing distance set at $3, our trailing stop will stop out at $28, $3 away from our entry point. But nothing happens yet. Then the stock falls $1. Since the high price point was 31, the stop out point remains at 28. Then the stock goes up to 33. A new high price point is established, and the stop out level follows right along, always $3 from the high price. The new high price is now 33, and the new stop out level is 30. Then the stock falls $2, only $1 away from the stop out level. Still, nothing happens. Next, the price of the stock goes up $4 to 35. The trailing stop follows right along with the stop out price level established at 32. Notice how the stop out levels go up but never go down. Finally, the price dips below 32 and the market order is triggered. So why don't more people use trailing stops? Two reasons. First, they don't understand how they work, so they ignore them. Second, trailing stop orders are sometimes difficult to set up. You have to remember to place one order to open your original stock position, and then place a second order, the trailing stop order, once the first order is filled and your position confirmed. Hard to keep track of sometimes. At Choice Trade, we introduced the contingent trailing stop. This is an order type that allows you to set up an original opening position along with a trailing stop on that position, all in one order ticket. By checking this box and filling in your trailing stop distance, either in absolute dollar terms or percentage terms, you effectively hold back your trailing stop until the first buy order is filled. So before you make your next trade, think about whether you want to use a stop order to plan your exit point or entry point on a position. Stops are a great tool. One last point. At Choice Trade, stop limits can be used for all types of stocks, but simple stops cannot be used for pink sheet stocks, and trailing stops cannot be used for either pink sheet or bulletin board stocks. A small point to remember. Thanks for tuning in. See you next time.